This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the button over Luke Roman's picture saying looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed a great big 3.9 million barrel build on crude oil inventories and another 1.1 million barrels of gasoline builds. The only drawdown on the board was distillates drawing down 1.3 million barrels for a net petroleum build of 3.7 million barrels. Cushing, Oklahoma building 840,000 barrels, still holding just barely above operational minimums. U.S. production ticked up 100,000 barrels to 13.3 million barrels. There's a major tug of war between the bearish view, which is, hey, look, there's plenty of spare capacity, and OPEC Plus is staying the course on increasing production starting at the end of the year. So there's plenty of room for much lower crude prices. And then, of course, the bull argument is, yeah, but that's all true, except the Middle East is about to blow up, and the sky is the limit, with $250 plus on crude oil being not the slightest bit out of the question in certain geopolitical outcomes that haven't happened yet, but the setup is looking awfully rich. So needless to say, fasten your seatbelt, folks. Oil volatility in either direction could increase considerably from here. In terms of the ultimate outcome or resolution to that tug of war between the bull and bear cases, my expectation is that continuing geopolitical escalation is going to lead to much higher oil prices, and that those higher oil prices will then later be sustained longer term by the structural supply-demand imbalances that are projected by JP Morgan and others to come into play in the oil market by 2027 at the latest. But a trip down to $40 before we ultimately rally north of $200 is entirely possible. So I'm not making any long-term bets now. When oil volatility calms down a little bit, I'll start accumulating out-of-the-money call spreads on long-dated futures in the late 2020s. But right now, I don't think that directional bets make sense unless it's a short-term bet based on some understanding of where the geopolitics are headed.
Eric, I couldn't agree with you more that spare capacity has been dragging this oil market lower. On page 2, we have the chart on crude oil, and that persistent pattern of lower highs and lower lows in the downwards channel has been uninterrupted. And even this little short squeeze that happened based upon escalation of geopolitics hasn't really broken the trend. We can just draw a trend line along all the previous highs. You can see that 50-day moving average. We haven't yet seen anything indicating that a new bull cycle has begun. But the geopolitics create a very interesting situation because most traders currently are positioned short crude oil. When we take a look at trader positioning, almost all CTAs are essentially short crude oil because the primary trend following techniques are all still indicating a primary downtrend. Then when you take a look at the number of hedge funds bearish NYMEX oil, we find them very short the crude oil contracts. You then take a look at managed money short positioning. It's almost at a decade high. Now that this in itself doesn't mean that oil has to reverse because of that, but clearly when we look at how everybody is positioned, where is the pain trade? Well, pain trade is if the geopolitics escalate and many of these traders are being forced to cover those shorts, we could have a liquidity-driven short squeeze rally that has nothing to do with spare capacity. And so the bigger question, are we witnessing something creating a feedback loop that actually drives that short squeeze? That's the thing to watch. And what I would certainly be interested interested in is to see whether crude oil can get above that $72, $73 area. Then it would be forcing higher highs, breaking above the trend lines, breaking above the moving averages. All sorts of signals to stop the positions out would be flared, and then you would have potentially oil shoot up to even $80, $82 purely just on that liquidity shift. On page 3, I have the crude oil volatility index you suggested. And this is the tricky part, because buying long gamma options here, like you suggested, is rather expensive. And we are now at multi-year highs in terms of volatility premiums on crude oil. And this obviously would be more favorable for buying options if this came back down below 40 on that upper range. But clearly we can see that right now option premiums in the crude oil markets are commanding lots of volatility premium. Let's move on to equities. Eric, what are your thoughts here?
Well, so far, this tape action borders on boring. We just rallied to an overbought condition on the S&P, and now we're starting to consolidate, with E-mini futures trading just below the short-term moving averages as of early on Thursday morning. But markets hate uncertainty, and my prediction is that between geopolitics and the U.S. election being only a month away now, we'll have no shortage of uncertainty for the next few weeks. So I think anything is possible here in either direction, depending on the news flow.
Well, Eric, that news flow is right and starts with the jobs numbers coming out tomorrow morning. Now, if they come in line, it may not be a market mover, but if there is a jobs miss, that could certainly spook the markets that the Fed is onto something and there's a rationale behind those rate cuts, and that could spur a distribution cycle kicking in. But really, all eyes turn to the earnings. While everyone has an expectation of earnings growth and the guidance to continue to indicate that, if there's any indication that a slowing economy is going to start impacting earnings, I think that is actually a big factor that could drive a market reversal. Now, I'm not predicting any of those things happening, but I think those are the kind of inflection points that will be worth watching as we go into these elections. Now, moving on to the levels on the S&P 500, with the VIX at the 20 level and the S&P at this 57.43 at the time of recording, it implies a 1 month range of 330 points, which is basically an S&P upper range around 6,075 and a lower range around 5410. Now, the market here is certainly pricing some volatility going into these elections, but will be really interesting to see whether that volatility contains at the 5,600 support line. That's where the 50-day moving average and the 50% retracement of the September rally lies. The way I look at it is the bulls have been and continue to be in control of the price action. Higher highs, higher lows, dips being bought, primary uptrends not being violated. This trend is in place, and to me, the market staying above 5,600 will continue to confirm that. A break below 5,600 would be the first warning signs of a potential topping formation, and that would essentially mean that the markets are getting heavy, with the fact that the NASDAQ and the Russell have failed to break to higher highs, and as well on some of the global developed markets like the Nikkei and the Eurostock also failing to make it back to their previous highs. The market may be actually still creating a bigger topping formation, with only the S&P 500 being able to temporarily break to these higher levels. Will this become a very heavy market going into the elections and in the post-election period? This is certainly one of the puzzle pieces we're going to have to solve. All right, let's move on to the dollar. What levels are you watching here, Eric?
I've been watching for a daily close below 100 or above 101.5. That's the level that we haven't traded above since August 19th, but we just popped our heads above it on Thursday morning. Let's see what happens. If we get a sustained rally here, and I think it will probably be short term because I don't think that the bottom is in for the dollar. But if we can break above 101.5, it might mean that there's a counter trend rally beginning that could take us up for a while before we ultimately move lower. If we see a daily close below 100, that would be the indication that that's not going to happen and that the move to the downside is going to continue without that counter trend rally. Let's see what happens, though. I have a feeling that maybe we're about to see some counter trend action here.
Yeah, on page 5, I have that US dollar index. And what we see is now a pretty distinct reversal off the lows. Was that a double bottom? We're breaking the neckline of September. It's really being driven by a euro weakening. And that's actually going to be critical. The euro remains the largest weighting in the dollar index. And if we see that the euro can't hold the current support lines, then we could see the dollar index head back to 103, 104, which would be a break of this downtrend that's basically been in place over the last 3 months. Right now, definitely showing signs of short-term consolidation and the exhaustion of the selling cycle that was already in place. So will we get that mean reversion back to 103, 104 is actually something I think is quite possible here. Eric, let's move on to gold.
Well, I remain super duper bullish long term. But look, this market has been way overbought for at least 3 full weeks now. And despite being overweight long gold, my strong hope is that we'll see at least a pause in this rally, if not a meaningful correction or pullback before the market resumes. And I say that just because I don't want to see this gold market go parabolic from here to where we have to worry about a blow off top and a major reversal to the downside. I think a healthy bull market needs to consolidate and correct from time to time, and we need that in order to protect the strength and integrity of this gold market. So I'm actually keeping my fingers crossed for not too much more excited upside too quickly in gold, because I might have to sell it if that happens, and I don't want to do that. There's a huge geopolitical premium in gold right now as well. And all it would take is just a temporary cooling off on either the Israel or the Ukraine conflict in order to set the stage for a downside correction of $100 or more. If that happens, I'll be buying hand over fist, and I definitely think it's a conviction buy.
Eric, I agree that staying long-term bullish gold makes a whole lot of sense on a macro scale. The bigger question from a technical perspective is, how do these short-term cycles play out? 2,700 was an upper target zone for me from a technical perspective. And this is a point where gold could reach a short-term exhaustion point and consolidate. That doesn't make me bearish, doesn't make me short, but rather gold does these things where it bursts higher and then consolidates for a couple months. Are we approaching that kind of an inflection point? I think that even if we did see a short-term consolidation in gold, it should likely be contained to 2,600 or 2,550, and therefore I would be buying old dips on any type of a gift if they gave you a quick drop like that. I've currently hedged up some of my gold holdings with the profits being made, and at this stage, while I remain bullish and primarily long, I'm doing so on a hedged basis. Now, moving on to page 7, I have the chart on silver. Now, gold has been ripping to 2,700 on the upside, but silver has just managed to make it back to its May highs. The big question and puzzle to solve here is, will silver have enough gas in the tank to break to a fresh new high? This is pretty significant because when a stock breaks to a 52-week high, it usually creates bullish follow-through that can continue. And if we did have that break of this $32 level, I don't see any reason why the completion of a measured move up to the $34 to $36 area can't complete. Now, moving on to page 8, I have the copper futures chart, and I just wanted to highlight the fact that copper has been holding up very well. We've obviously been in this 4-month bear market where copper consolidated downside, and now for the first time, we've spent almost a month trading back above the 50-day moving average, very reminiscent of the March and April period earlier this year. The bigger question, can all consolidations be kept above that 50-day moving average and be bought on dip? At this stage, the levels to watch are all around the 430, 440 areas. Any quick dips down 20, 25 cents on the downside would be buy on dips, and we'll be watching whether or not continuation patterns that push copper back to its May high get in place. Now, moving on, I wanted to touch on natural gas. Now, rather than using a continuous chart, which is rolling up the term structure, making natural gas look more like it's in a bull trend, it really is just simply rolling up into winter gas prices. I think that looking at the strip is much more effective. So I have a chart here of the natural gas 12-month strip. And what we can see is that after a 2-month sideways consolidation along the lows, we're seeing the first period of an attempt to turn the trend back bullish on the upside on the entire strip. The big question is, will this lead to some follow through? Obviously, weather will be a dynamic going into winter, but at this stage, it is at least trying to bullishly break out. And if this follows through, maybe we will see June prices again. Now let's move on to uranium. Eric, what are your thoughts?
Well, Patrick, with Cameco trading over $50 on Thursday morning after having traded as low as 37 a week or two ago, it's finally looking like, barring a broad market liquidity event, the bottom is probably in now for this long correction in uranium mining shares. But the brisk upside reversal left plenty of gaps in the charts well below the current market. So there's plenty of room for an air pocket to take us back down to fill those gaps. And if that happens, it's definitely a conviction buy. The fundamentals couldn't be more bullish generally, and Russia appears to be about to ban export of uranium and enriched uranium products to the West. Now, I do want to express one word of caution about that, because I hear a lot of people in the uranium world jumping for joy saying, oh boy, if Russia does that, it's to the moon for uranium prices. Well, hang on. It might not be quite that simple, because Russia doing this, more than anything else, is going to have the effect of really taking Russian enrichment services offline. So we're not going to be able to access enriched Russian uranium from the West because of Russian sanctions against the West. Is that a big deal? Yeah, I think it actually is a big deal. And the reason is that we're very dependent on those Russian enrichment services. We don't have enough enrichment services in the West to support ourselves. And without Russian enrichment services, and remember that without those Russian enrichment services, you have to think about the supply-demand fundamentals for the uranium a little bit differently. Let me share a story from early in my crude oil trading days. This was more than a decade ago. I remember a really big storm headed into the Gulf of Mexico. And as a pilot and a sailor looking at the weather charts, I was convinced the weather was worse than the market, the oil market was discounting. The oil traders were not as concerned about the weather as I was. So I went long oil into a weekend that a big storm was going to hit Houston. And sure enough, on Sunday evening when the futures market opened, it was up huge because of the massive storm surge causing all kinds of flooding in Houston. And I looked at the big gain on my trade and went to bed on Sunday night thinking I was a genius. I woke up Monday morning in absolute terror, looking at a huge loss on my account. Well, what happened was the dumb speculators like me who didn't really work in the physical market and didn't understand how it works were making those speculative trades on Friday afternoon and Sunday evening. Then the big boys who actually work in that market came to work on Monday morning and said, these floods are going to take 3 refineries offline. That meant that end products, RBOB gasoline, was absolutely crazy upside to the moon, while crude oil was straight down. Because with the refineries offline, they can't refine the crude, and they don't have a place to store it, and that creates a backup. Now, with uranium, we don't have the physical challenges of storing crude oil, which is very bulky in large tanks. So the running out of tank space is not a factor in uranium the way it is in crude oil. But I still think there's a risk here that there could be an unexpected twist to this Russia story where everybody thinks it's going to be upside for uranium prices. It turns out that it ends up squashing raw uranium demand, because effectively it's the refiner as opposed to the source of the raw material that's been taken out of the equation. So let's keep a close eye on what happens with respect to that. I don't think many analysts are looking at that particular nuance of this Russia story.
Well, Eric, the uranium has been in an 8-month consolidation. It's been a pain point for a lot of the people that have been very bullish. But we're now, for the first time, seeing some accumulation, positive price action, good flows. This could be a trend shift. We're going to be watching closely whether a new bull phase has begun. Clearly, some of the individual names like Cameco or the URA as a broader ETF have really come to life. There'll be certainly money flow coming into this space, and we'll see whether or not this 8-month correction is finally behind us. I wanted to wrap things up here, Eric, by looking at the Bloomberg Commodity Index. And what we've had is a 2-year bear market in commodities when looking at it, a broader basket. But there's been divergent momentum for the last year. And there hasn't been any aggressive sell cycles that really followed through. And that really begs the question as to whether or not we're going to see, particularly driven by the new China stimulus and a lot of the money pumping in, will we see finally commodities come to life? We certainly on the short term have seen that over a few weeks, but the bigger puzzle to solve is that does this now create a new 6-month or 1-year bull trend? I certainly think it's on the table and is something that I'm going to be watching closely with my members. Finally, I wanted to touch on U.S. 10-year Treasury yields on page 12. Now, we have had an epic bond run as yields collapsed all the way down to 360, and now it's consolidating. It's consolidating into tomorrow's jobs numbers, and this will be the interesting thing. Obviously, if there's a bad jobs miss, then we could see yields drop again as bonds break out, as confirming that we're heading toward a recession. But if the jobs numbers come in line, we could see continued consolidation toward 4%. This was a huge overshoot and a big move, and some consolidation back to midpoints of the ranges, and the market starts pulling out 2 or 3 rate cuts is entirely possible.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.